Welcome to those of you already in, but as the participant count is still increasing, we see that people are still coming in and continuing to connect. So we'll wait another 30 seconds or so. Yeah, well, it seems that the participant count stabilized. So seems that people are still trickling in slowly, but we're going to, oh, now as I'm saying it, it keeps coming up. I'll wait another 5 seconds, 10 seconds. Okay, 11:02. So welcome everyone to our next iteration of Microstructure Exchange. Before I turn the floor over to Haoxiang, there is one announcement. We're accepting submissions for winter 2021, the winter term. So to submit your paper, please go to our website, Microstructure Exchange, and just fill out a short form and send your paper in. We are looking forward to reviewing papers. Of course, my phone rings at the time I'm talking to you. Sorry about that. I can't even pick it up. So that distracted me. Apologies. I'll continue. Submissions are accepted, so please go to our website. Now, before we start, I'd like to remind you of the rules for the webinar. The webinar is moderated. I'm the moderator. I'm Katya Malinova. I'm with the DeGroote School of Business at McMaster University. So Haoxiang is going to speak for about 45 minutes with 2 or 3 breaks. During the breaks, we'll go through questions. Please submit your questions during the talk through the Q&A function. And if you have a question that is similar to yours already in there, please, we'd appreciate if you just upvote the existing question instead of submitting the new one. And then at the end of the 45 minutes, we'll open the floor for a normal discussion. So with you'll be able to raise your hand, and then we'll unmute you, and you'll be able to ask your question with a microphone. And Haoxiang also agreed to stay for a little bit longer if we run out past the official ending time of noon. So with that, I'll turn the floor over to Haoxiang, and he'll talk to us about market making and matchmaking and whether bank regulation harms market liquidity. Thank you very much, Haoxiang.
Well, thank you, Katya, and I want to thank the organizers for inviting me to speak to this great audience and into this great forum. Today, I want to present the work joined with Gideon, Saar, Jian, who is a student at MIT, and Ron Yang, who is a student at Harvard. The topic is about market making and matchmaking. The question is, does bank regulation harm liquidity? The answer to this question, as I'll gradually unfold throughout the talk, is a qualified no. In fact, we'll show a contrary message, which is that bank regulation post the last crisis has somehow increased the market liquidity according to our theory. And the theory is consistent with the data that many of you have investigated in the corporate bond market. So let me see what's going on. Try to go forward. So the background is that there has been a lot of regulation since the 2008 and 2009 financial crisis. Here I'm listing the few. And of these, I think in the bond market, the mostly commonly talked to, the regulation that are mostly discussed about the Volcker rule and the leverage ratio. So the concern is that, let me see, the concern is that because the banks now have faced a higher balance sheet cost, and when they take liquidity, when they kind of provide liquidity to customers, they would have to think about the cost that the regulation imposed on them. As a result, the bank's going to be less willing to provide the liquidity. So this concern about liquidity has surfaced as early as the early days of regulation, let's say around 2012. Now the issue of this argument, however, runs into the I mean, in fact, generally the regulators also agree that the market liquidity might have been harmed because of the regulation, as highlighted by the last sentence. Improved resilience of market makers brought about by regulation raised the cost of market intermediation. This is from the BIS. So all of these concerns, however, are not entirely consistent with the data. So this chart shows the corporate bond market transaction cost taken from the Fed report. The latest one actually is Q2 2017, and after that they stopped. And you can see that from this chart, the transaction costs in the US corporate bond market have in a sense declined, right? So this number is sort of smaller than the number on the left. So at least in the broad trend, it seems that the transaction cost in the corporate bond market, at least is comparable to before the crisis and even a little lower. And moreover, on the bottom right corner is really small. This is the transaction cost for a 1 million shares in the typical $30 stock, as estimated by the equity market structure in the 21st century by by Chester Spad and Harris and oh, sorry, I forgot about the other one. But what you can see is that the transaction cost in the equity market has come down in the early 2000s. So the further reduction in the transaction cost is not really in the corporate bond market. It's not really due to technology, because technology in the equity market seems to have come in a little earlier. So if we expand this a little bit, and according to the empirical evidence, the picture is really nuanced in the corporate bond market liquidity. Number one, we have already seen that average transaction cost is lower than pre-crisis levels. Number two, which is quite interesting, is that the cost of immediacy from the dealers have gone up. Now, this is from work, empirical work that have shown that, for example, as the bond is taken from the investment grade downgraded to high yield, or in the distressful kind of sale period, the cost for trading with the dealers have gone up. And furthermore, market making and capital commitment of dealers have come down, and this is mostly due to the banks kind of retrenching, but the non-banks have, in a sense, stepped up, but sort of insufficiently. Now, in all of these discussions, I guess I've been trying to convey the message that the empirical evidence does not necessarily support the idea that the corporate bond market has become less liquid. Now that's kind of the round two message. Now the round three message from the proponents or the kind of opponents of regulation is that, wait a minute, from the data, it is impossible to affect to judge the welfare impact of regulation, primarily because if investors realize that the immediacy is so costly that they just have to incur very costly delays, right? This delay cannot be captured by the data because the data are, in a sense, conditioned on transaction. And moreover, if investors just cannot find the liquidity, of course, the lost trade opportunities would be another pretty big welfare cost. None of this could be possibly captured by the transaction data. So what is the policy response, right? Which is a very important question, and therefore cannot be really judged by the transaction data alone. So this is where we need a model. Let me briefly talk about the main message of the paper. So we start from the premise that there are a couple of key assumptions. Number one, which I think is realistic, is that bank dealers provide the liquidity in two ways. There is a traditional way for liquidity provision called the market making, and we can call that principal trading, in which case the bank takes the custom order on its own balance sheet, right? And take some time to offload them. So in this case, it is the balance sheet that is used primarily as a way of financial intermediation. Now, the second method of liquidity provision is matchmaking, or we call them agency trading, or sometimes riskless principal trading. Now, this relies mostly on technology. Instead of taking the customer sale order of a bond into the balance sheet, the dealer said, hold on a minute, I'm going to find you a buyer. And in the meantime, it is the customer rather than the dealer or the bank that suffers this waiting cost, right? So in usual, well, at any point in time, I guess the bank dealer would optimize the two methods of liquidity provision, balance sheet and the technology. and they have market power. That's the important assumption. I just want to highlight now that as long as they have a bit of market power, that's sufficient. They do not have to be a monopolist. Now, what are the consequences? Number one, due to market power, bank dealers actually put too little effort into matchmaking, right? Even though technology was available, and even though matchmaking is sort of more advantageous to investors, bank dealers just do too less of it, right? Not enough of it. Instead, they would want to at least sort enough liquidity into their market making business in order to earn a higher profit. Now, what the bank regulation did is to increase the balance sheet cost of dealers, of bank dealers, and that encouraged them to do more matchmaking because the profit margin on the market making piece is now lower. Now, that shift is actually expedited by the competition from the non-bank dealer. Think about this as Citadel, right? All these proprietary trading firms that have been very successful in equity market to take the market share from the traditional bank liquidity providers. Now they are also in the bond market. Now, when the banks are facing the competition from them, there is sort of a limit of how much spread they could widen to customers because of the non-bank dealers competition. Because of this shift into matchmaking, we can show that during the transition, an increase in the bank's balance sheet actually improves customer welfare, right? So that's the key message we're trying to convey in this paper. And if there's anything you want to kind of pick out from this paper, I think this is the key message. Under certain circumstances, we can show that an increase in the bank's balance sheet cost improves customer welfare. Now, of course, it's bad for the banks, but customers are nonetheless better off. And this is generally a part of a general transition across many asset classes from OTC or bilateral trading, or, that relies heavily on dealers' balance sheet into a new world in which technology takes a central role. Should I pause here, Kadia, or we can continue?
Well, there is a question from Lian Yang. So the question is, the paper by Terry Hendershot et al., True Cost of Immediacy, shows that bid-ask spread may not be a good measure for liquidity. Any effect of this view?
Yeah, so this is a good point. I think this is exactly what we are trying to do. In the I know about that paper. I think they're right in the sense that the transaction costs do not capture fully the delay cost, right? That's where the theory is useful. This is where we're going next.
And that is a segue to Lian's next question. Would be great if you can discuss the relation to the traditional literature. So back to you.
Okay, so well, I was about to skip the literature. So let me actually briefly talk about this couple of pages and then skip in the interest of time. Now, what do we know from the transaction costs about the transaction costs in corporate bond market? The answer is that it has improved, or at least there's no change. At least in a few papers. I'm sure some of you know them, and some of you actually write these papers that we rely on. And the cost immediacy have increased depending on whether it's downgrade or exclusion from an index. And in terms of the market share and the trading mechanism, there's been a shift toward the matchmaking away from market making. And the banks dealers activity seems to be the sort of responsible in this driving this shift. So I'll skip this one in the interest of time. I guess we can talk about the general literature later, maybe after I talk about our main results. So let me talk about the model right now. So we first discuss the model. I'll show you the equilibrium and the implications. If we have time, I'll talk about the robustness, where we kind of give the bank dealers a bit more competition, but still not perfectly competitive. So here's the model. It's a fairly straightforward model. We have one asset, and the expected value of the asset is assumed to be V, which is common knowledge, and everybody is risk neutral. The discount rate is Saar. There are infinitesimal buyers that arrive at the flow rate of mu. Think about this as, it's a mass, right? So basically every buyer is tiny and small, has absolutely no impact on anything, and they arrive as constant flow of mu. so that during the period of time dt, right, the mass buyers will be mu times dt. When the buyer arrives, the buyer wishes to buy 1 unit of the asset because of the private valuation, for example, the hedge need, or some kind of investor flow. And the private value has a distribution of G over this interval 0 to infinity. Now sellers arrive at the same rate on the other side of the market and have exactly the same distribution of private values. So in this model, all the trading motives is driven by private values instead of information, right? So that's one important kind of feature. We are talking about the customer's private need rather than informed trading. The customer's private value is only observable by that customer herself, right? And then nobody else, including the dealer, cannot see that. What is the assumption? Technical assumption here is that the inverse hazard ratio is not increasing x, which implies that the virtual valuation is increasing in x. Now, just keep that thought in your mind for now. We'll talk about why this assumption is useful later. Okay, there are two methods of liquidity provision by a bank dealer. We are going to assume that there is a single bank dealer that is representative, right? Think about this as a model for the bank dealer sector. Think about this also could be like big bank like JP Morgan. JP Morgan uses market making and matchmaking. Market making means the bank is going to take the custom order on the bank's balance sheet with the other side with a spread of S and B in order to compensate for the balance sheet cost that could be the regulation-driven balance sheet cost of CB. Alternatively, the bank could tell the customer, wait a moment, I'm going to find you a buyer or seller, and by incurring a cost I, the bank is going to match the custom order to the other side with the intensity of H with exponential distribution. So with the exponential arrival time, the expected waiting time is 1 over H. And the nice thing about exponential distribution is that it's memoryless, right? So it doesn't matter how long you have waited, the expected waiting time is always 1 over H. In order to compensate for this service, the bank dealer would charge a fee of F. There is also a non-bank dealer. We also, just for simplicity, assume that it is a representative strategic non-bank dealer, say Citadel. And the non-bank dealer only does market making with a spread of S and B in order to compensate for the cost of balance sheet C and B. I'm going to put the 3 endogenous transaction cost numbers, right, in boxes, S of B, F, and S of NB. Okay. Now, how do we interpret this difference in the balance sheet cost? We can think about the market or capital market driven activity based cost of capital as CNB, right? We can think about this as CNB. So whatever Citadel is doing is incurs the cost of CNB because of the inherent risk. But when the same activity is conducted by the bank, there is an implicit subsidy because of too big to fail or because of deposit insurance, right? Whichever way it is, there is an advantage of banks in doing that. Now, post the crisis, post the last crisis, well, we're in the new crisis, post last crisis, regulatory costs have gone up. So what we are trying to do really is to start CB as pretty low level and try to increase it as a proxy for the increase in regulatory cost, balance sheet cost post regulation, and see what happens. Now, let me briefly talk about the customer strategies. Now, given the setup, it's pretty straightforward. Remember, customers are just price takers, right? They arrive, they look at these 3 prices, SB, SMB, they pick the smaller one and say, well, if I pay for the market making service, I'm going to pay S, the big S, and conditional on the private value of X, I'm going to get X minus S, right? Alternatively, the customer could use the bank to do matchmaking. Oh, by the way, I should mention that the non-bank dealer like Citadel does not do matchmaking. So the bank is the only provider of matchmaking due to its vast customer network. So the customer could use the bank to do matchmaking to pay a fee, but there's delay, right? The delay is exponentially distributed with a parameter of H. So if we do this, you see that the gain from trade X minus F is realized only upon matching. So there's a discount. We call that a script H. So clearly, there's a bit of delay. And the last option is to forego trading altogether. Now, how do we kind of find out the threshold point at which the customer is different between paying the spread and searching? That point is given by this number B, right? So the threshold private value benefit B is given by this equation right here. Now, given this characterization, it seems pretty straightforward to characterize how the customer would sort, right? They would sort into 3 pools. Now, people with the highest value of immediacy, they would pay the spread right away. People with immediate or kind of intermediate value of immediacy, they would search and pay the fee of F upon matching. And people who have the least amount of kind of private need of trading, they would simply exit the market and not doing any transaction. So the customer welfare would simply be the sum of everything of the 3 populations. The first population, no trade, 0 utility. Matchmaking population, remember there's this discount, which is not observable in the data. And finally, the market population just take the spread. And the bank dealers and the non-bank dealers profits given by the 2 expressions. There's a lot of symbols, but intuitively, there's a bunch of customers who use the bank's matchmaking service. That's a profit. And there's a bunch of customers who use the bank's market making service. Now, of course, only if the bank offers a lower cost than the non-bank do the customers use the bank. Right? Analogously, we can define the non-bank's utility right here. Okay, so basically the equilibrium consists of the strategies of the bank, the non-bank, and the customers. The customer strategy we already solved so that everybody maximizes their own profit. What we're going to do is to increase the cost CB and see what happens, right? This is a proxy for the increase of the balance sheet cost of the banks brought by regulation. Now let's talk about the equilibrium. Before showing you the formal propositions, let me quickly show you the shape of the equilibrium. So here I'm showing 2 graphs, right? Essentially, well, very similar between the 2, except there's a tiny difference in the parameters. On the x-axis, I'm plotting the cost of the bank's balance sheet, CB. On the y-axis, I'm plotting the cost of searching, or kind of effort or technology, whatever you call it, I. Along the diagonal, that's the I equal to script H times CB. Now we are going to restrict our attention to parameter regions in which matchmaking takes place, right? In other words, below the diagonal. This is quite intuitive because if the search cost is too high, then matchmaking is not the efficient method to do to start with. But given the prevalence of matchmaking now in the market, I think this is useful, at least for the empirical sense, to kind of focus attention here. So we are only look at below the diagonal. Now there are 2 possible regions depending on whether CB is greater than or less than this fee of CMB, which was the virtual value I was talking about earlier. But for now, let's focus on this. In region A, we are in the so-called constrained bank dealer equilibrium. We call that constrained. This is because the bank's spread in the market making is constrained by the balance sheet cost of the non-bank, right? So JP Morgan can only charge as much as the cost of Citadel. If it charges more, well, then customers go to Citadel. In region B, we are in the unconstrained bank deal equilibrium in which JP Morgan charges the optimal spread that happens to be lower than the Citadel's balance sheet cost. So in this case, JP Morgan is really unconstrained. It chooses the best spread it could, and the Citadel does not really pose any competitive threat. Now, in order to give you a bit more intuition of why we have this technical condition, let me just go through this 1 page of math, kind of to get some idea behind it. We can consider a monopolist bank dealer's profit maximization problem, which is to choose a spread minus balance sheet cost times the population or the mass of customers who use market making, right? Now, the first order condition could be written as the cost of balance sheet cost is equal to the spread minus something else. And this whole term, right, is the virtual valuation, phi of S of B. Now, if we plot it, we can see how the first order condition would work out. So remember that we have made that assumption that the right-hand side is actually increasing. So it looks like this, yeah? And we know that if the bank charges only its own balance sheet cost, it's going to make 0 less is going to make a profit that is negative, right? So this number is actually less than CB. Yeah. Now the question is, what if the bank charges the non-bank dealer's balance sheet cost? Well, there are two cases. In the first case, if this point is greater than CB, then it is possible to find an interior solution, right? So we would call that, SB star. Now, a different situation is when CB is right here. I'm sorry, it's a little messy. I'm trying to use eraser. Another possible solution is when CNB is here, so that if you take the virtual valuation, it's actually below CB. In this case, the bank wishes to increase the spread charged to customers, but it is bounded above by the non-bank dealer's balance sheet cost, right? This is why the virtual valuation at exactly CB kind of matter. So that's why there are two possible graphs, but intuitively, the intuition is very similar. The question is whether the bank's spread charged on customers for market making is restricted by the non-bank's competition or not. Okay, so here's the formal proposition. I think I'm going to skip, but generally it just says we can solve the model. Okay, and here's a more interesting one. We're talking about the comparative statics. Now, when CB increases in the constrained bank deal equilibrium, remember, this is the equilibrium in which JP Morgan's spread is constrained by Citadel's balance sheet cost. So the spread got to be unchanged, right? It is kind of bounded above CNB. As the bank's balance sheet cost start to increase, the bank's total profit in market making goes down, right? Because the fees, the spread is fixed, whereas the cost is going up. In order to kind of optimally allocate the resources between the two methods of liquidity provision, the bank's actually going to do more matchmaking, right? And as a result, the matchmaking fee would decrease in order to equate the marginal profit from market making and matchmaking, right? So the fee would go down. Because the fee now goes down, we can show that the average transaction cost also decreases because the customers who go to market making pays the same spread as before, and the people who go to matchmaking actually pays lower matchmaking cost. As a result, trading volume increase, matchmaking increases, and the market making decreases. Overall consumer welfare increases, right? So this is sort of the key message. If there's anything you want to take away from this talk, I guess, is this point. Overall customer welfare increases as the bank's balance sheet goes up in the constrained bank deal equilibrium. And and again, on the bottom is the chart. You can see that as the bank balance sheet goes up, the F starts to move to the left. Now here is a different case of equilibrium. That is the unconstrained bank deal equilibrium. In unconstrained bank deal equilibrium, the bank simply solved the monopoly problem. And to solve the monopoly problem, find the solution, it turns out the optimal spread charged on market making is lower than the non-bank's balance sheet cost, right? JP Morgan can do whatever it wants, and the Citadel does not pose any competitive threat. In this case, apparently, if the balance sheet costs start to go up, then the bank is able to pass on all the balance sheet costs to the customers. Therefore, the spread goes up. The fee doesn't really change for matchmaking. An average transaction cost is somewhat ambiguous. In fact, it's kind of hump-shaped. If CB is relatively low, it increases. When CB is really high, it could decrease. The trading volume is really unchanged because F doesn't change. Matchmaking increases and market making decreases. Now the following two, these two are kind of the same as before, but the very important difference is that the overall customer welfare start to decrease. Now the reason is that the bank dealer is now able to pass on all the regulatory costs on the balance sheet fully to the customer, right? The customer would do worse. Now when we kind of think back to all the discussion of why liquidity might be worse given regulation, I think this is what people had in mind, right? Because dealers use their balance sheet, they take that as given, dealer use the balance sheet, and any increase in the balance sheet cost got to reduce customer welfare. But again, if we sort of go back to what we did discuss earlier in the constrained bank equilibrium, the key idea is that yes, dealer balance sheet gets more expensive, but dealer is endogenous, right? The liquidity provision is endogenous response. they are shifting away from the expensive form of liquidity provision into this cheaper and more efficient method of liquidity provision. So in that shifting process, that increase the customer welfare. Now, this is sort of a summary table that shows the theoretical predictions in these two regions, right? Still conditional on the bank's balance sheet cost lower than the non-bank's balance sheet cost. We can see that the market making and the matchmaking, market share kind of have the same change. The difference is that number one, transaction cost, right? In the beginning, it goes up and it goes down, whereas in the constraint case, it definitely goes down. And the second, the customer welfare has very stark differences. Now, what can we do, right, to kind of use this theoretical prediction to connect to the data? We know that in the data, transaction costs have come down, right? Even though the spread have come up, right? In other words, the immediacy costs have come up. So it seems that given this prediction, we are either in the right range of region B, or we are already in region A, right? This is where the average transaction cost would have to come down, and the spread has already increased. In fact, if we could also show that if we could also kind of find, in the data that indicates we are already in region A, then in this case, the customer welfare would actually increase in the dealer's balance sheet cost CB. So Katia, should I pause at this moment?
Yeah, we do have a couple questions, actually, by now more than a couple. So the first two came before the equilibrium, but it seems actually related. Sure. Now you're back to data. Daniel Pozmik asks, could it be that the reduction in spread is because competitors to traditional dealers like Citadel arrived only after the crisis in the bond market, and this cannot be compared with how spreads behaved in equities in the same period?
Yeah, that's fair. I think the non-bank dealers, they were interested in bond market making for a while. I think, for example, I mean, if you don't like the Citadel example, I think the market access is another example, right? So market access is an electronic platform. It's been around for 20 years. So I think you're fair that the bond market is different from equities. So maybe putting the two charts side by side is a little misleading. But I think the general point I'm trying to make is that the technology was available before the last crisis. It's not that technology wasn't there. Technology was there, but somehow dealers are not using it.
So the next question here is from Pankaj Jian. Traditionally, bank intermediation through commercial loans has been quite different from secondary market trading. Does the specialization of non-bank market makers allow them to exploit economies of scale, different from the economies of scope for banks that you're talking about?
Oh, I assume the economy of scale of non-bank market makers. I mean, I'm glad you mentioned the economy of scope. I think the economy of scope is very important for banks as a competitive advantage. I spent a very brief year in Lehman Brothers before the whole thing, right? Before I did my PhD. So I think the rhetoric back then within the bank was that we cannot possibly compete with the Citis and the JP Morgans because they have balance sheet. Lehman, of course, back then was not a commercial bank, and the Citi and JP Morgan were. So I think the thinking among the non-bank dealers was that they got to be more aggressive, right? So I think I'm not sure if what I'm trying to say is I'm not sure if non-banks were able to scale up as much as bank in that sense. It seems that they are gonna take activities that they are slightly higher risk, right? I think the market making is a slightly higher risk than matchmaking, and into riskier asset classes as Lehman and Bear Stearns did. So I'm not too sure whether again non-bank dealers are able to scale up more than the banks.
And so then we have one more question from Kumar Venkatamaraman. Perhaps you can model an extension of technology shock which arrived with a delay in corporate bonds. Due to bank customer flow, bank dealers enjoyed an advantage in market making and matching, CB and subsidy. With technology, non-bank dealers benefit more than bank dealers, de-leveling the playing field so CNB declines more. So will it lead to similar theoretical predictions on impact? Seems similar to higher regulatory costs, and if so, how do you sort it out empirically?
Oh, this is a good point. So Kumar is saying that as regulations start to come in, it is, I mean, both CB and the CNB changes, right? You're saying that technology goes down, technology cost goes down as well. So we do have a proposition later to showing what happens when I goes down, the cost of searching, but we have not considered moving CB and the CNB down simultaneously. Our thinking is that it's almost like CNB is a benchmark. This is the market-driven cost of liquidity provision. In other words, if you have to go into capital market and raise capital and say, okay, I want to do market making tomorrow, and what's the return on equity do you require, my investors? And we kind of use that as a benchmark, and we kind of will keep that fixed. But you're right. I mean, that number might be moving. The difference, I think, could be possibly told apart empirically by looking at the return on equity of specialized liquidity providers. Citadel maybe is one, but it does a lot of stuff. Citadel Securities, or maybe Virtual Financial. If we could find a pure play non-bank liquidity provider by looking at return on equity, we might be able to get a sense of what is the market return on capital, and use that as a proxy for CNB. Now, of course, things could be a little more complicated there to kind of connect data to theory, but that's what I think of now. Okay, so should I continue?
Yes, please.
Yep. So we have talked about the case when CB is less than CNB, right? So that's when the banks have an advantage than the non-bank in terms of market making. The recent evidence, say by Binder and co-authors, and then Kumar, of course, shows that the bank dealers now handle, say, 87% of principal trading, but non-bank dealers handle 13%, right? 13% is not, of course, 87%, but it's actually non-trivial, given that the non-bank dealers started off much smaller. So we also characterize equilibrium here. The general idea is very similar to the bank dealers equilibrium. Here we are talking about the non-bank dealers being constrained. In other words, as JP Morgan's balance sheet cost goes up so much, it's now becoming higher than the Citadel's. But Citadel cannot freely raise the spread as much as it wants because JP Morgan is still here, right? It's a sort of competitive threat. So that's when the two balance sheet costs are relatively close, that the non-bank dealer is now constrained by the bank dealer's competition. So as the bank dealers' balance sheet costs start to go up, these two start to diverge, right? The two balance sheets start to get further and further apart. As a result, the non-bank dealers are now able to increase this cost as well. And the bank dealer, which now specializes in matchmaking, is able to increase the fee. So once the bank's balance sheet cost goes up, you can see that both the immediacy, the cost of immediacy, and the cost of matchmaking start to go up. Nonetheless, the change in the transaction cost on the customer is a little ambiguous because customers, again, could switch from the more expensive market making into the cheaper matchmaking. Now, the point here, the main point, I guess, is that once we're in this region, the overall customer welfare, again, start to go down, right? So the general pattern is that whenever these two intermediaries, right, bank and non-bank, whenever they have a pretty different cost of capital, cost of the balance sheet, any increase, right, in the bank's balance sheet cost tend to reduce the customer welfare. However, once they get close enough, the increase in the bank's balance sheet costs actually improves welfare because that's where the competition becomes most intense, and that's where the shift from market making to matchmaking becomes the most active. Now, of course, in principle, there is another unrealistic, unconstrained bank dealer equilibrium where JP Morgan's and these banks are out entirely, and it is the non-banks that take over everything in liquidity provision. And of course, in that scenario, any change in the bank's dealers' balance sheet cost doesn't make any difference at all, right, on customer welfare. So for that reason, we're going to skip it. So now let me put everything together and only highlighting the predictions that are kind of different across the regions. Average transaction cost, again, if we sort of, as CB goes up, right, we first start with a non-constrained bank dealer equilibrium, it is hump-shaped, and later it starts to go down. And once you go to the constrained bank, non-bank dealer equilibrium, the average transaction cost become ambiguous. And the market making provider started with all bank because of the nature of the model, it kind of switches entirely to non-banks. So that switch is very stark, even though in the data, it is more gradual. And importantly, the customer welfare actually goes up in the middle region, right, in the constrained bank dealer equilibrium. Now, given this, what can we say in terms of connecting data to the theory? In the data, we know that average transaction costs have come down. And we know that the banks start to lose market share to non-banks in terms of the market making. So these two pieces of evidence suggest that we have already started to transition from the constrained bank dealer equilibrium to the constrained non-bank dealer equilibrium, right? So in other words, we are kind of here, and we are still, right, probably in the bank dealer equilibrium, but it's not too far away from the non-bank dealer constrained equilibrium. Now, what do we do in this case is that the transaction cost goes down and the customer welfare goes up. So this is why we were saying in the beginning that the model suggests that during this region, which seems to be what's happening in the data, the customer welfare would increase as balance sheet costs of the bank continue to go up as regulation, get finally phased in and finalized. Kind of more broadly, I just want to quickly mention that this is not an isolated case. There are many examples in the past that regulation seems to be the key catalyst for improvement in market structure, even though the technology was ready. So starting with the SEC's order handling rule, 1997, back then, of course, the incumbents were Nasdaq dealers, and this order handling rule permitted investors to compete with these dealers in providing liquidity, so that dealer would have to display customers' quotes. If the customers' quotes indeed better than the dealers, evidence suggests that, yeah, this has decreased the transaction cost by a lot. Then 2005, regulation AMS, now in this case, the incumbent was NYSE specialist, and they were too slow, and Reg AMS dropped the manual protection of manual quotations of the NYSE specialist and encouraged competition among exchanges. Then around 2002, FINRA introduced transparency in the US corporate bond market and the structured product later. And that has shown to increase liquidity and reduce transaction costs. In all of these cases, we know technology was available, but somehow the incumbents were not using them. So that's sort of the broad message that technology by itself may or may not be sufficient. Regulation seems to be the one that finally pushed over the threshold. So regulation helps investors to reduce the market power of dominant players, regardless of their entity types, right? So this is not a kind of bashing the banks or anything, but rather it is against whoever was the incumbent at the time. So do I have time for robustness? Yes, no, maybe.
Briefly, yes.
Briefly, yes, okay. So let me quickly talk it over the general idea. So in the main model, we have one bank and we have one non-bank. Now, it looks like there are more banks if they compete against each other. Now, obviously, if you introduce more than one banks and they are homogeneous, right, then they would compete all the range down to zero, right? We know that in the perfectly competitive case is a result that in the perfectly competitive case, the bank would earn zero profit, and any increase in the balance sheet cost of the banks would reduce customer welfare. That we kind of know. But that kind of go against the data, because in that sort of perfectly competitive model, the customer transaction costs would also have to go up as bank balance sheet costs go up. So which is apparently different from what the evidence says. So instead of introducing perfectly competitive model banks, we're going to introduce multiple bank competition, but the banks are somewhat differentiated, right? So the customers would have a taste for the bank, which is modeled as this distribution of F parameterized by this number sigma. That's a parameter. So we can think about this as customers arrive and they have produced a taste for different banks, and that's the entirely private taste. Because of the private taste to the banks are differentiated. They no longer compete head to head, right? They do not have to compete teeth and nail in order to get customer market share. they could get customers because of this taste. And depending on how big this parameter sigma is, we could model perfect competition when sigma goes down to 0, no differentiation, to perfect monopoly when sigma goes to infinity, right? That is the perfect monopoly. So in this range, we could model the degree to which banks are differentiated and therefore model the degree of competition. The only difference, I think, is here technically is that not only does any bank has to consider the sort of the profit making from these two activities, it also has to consider what if customers leave the bank, right? So this is the market share, right? Apart from this technical difference, conceptually, there's not so much difference from the baseline model. But this technical difference makes the model a lot harder to solve, which is why we're going to just numerically solve it and see what happens as we change the degree of differentiation. So here's the chart. What you see in orange is where the banks, the customer welfare improves as we increase the cost of bank's balance sheet. What you see in blue are where the customer's welfare goes down as the bank's balance sheet cost goes up. We are plotting this as a function of sigma and a function of the bank's balance sheet cost of CB. Now, the whole point of this chart is to show that under reasonable parameters, we see a lot of cases in which customers continue to benefit as the cost of the balance sheet of the bank goes up, right? In other words, what we are looking at is not really a corner solution, right? We are kind of looking at it here, right? When the sigma is very big. Nonetheless, you can see that even when sigma is moderate, like 20 basis point, we see a lot of parameter ranges in which the bank's balance sheet cost increase still benefit investors based on exactly the same intuition, right? The shift into matchmaking is more efficient and it is a low cost activity that customers benefit. So that's about it. I'm going to skip this last slide about alternative welfare measure and conclude. Now, the basic question we are trying to answer in this paper is how does bank regulation affect liquidity? And more importantly, investor welfare. The key message we try to convey is that in answering that question, we got to consider the change in the nature of liquidity provision from market making to matchmaking. Dealers' endogenous response into this alternative form of liquidity provision that is sort of visible already in the data, and therefore we have to take that into account when thinking about the welfare. Pre-crisis, technology was ready, but the transition was somewhat stalled by strategic considerations. It's almost like a cannibalization concern, right? As you sell more new product, you sell less of the old product. And the old product here is the balance sheet centric market making. Post-crisis regulation increased the bank's balance sheet cost, and that is a catalyst for this transition. And of course, non-bank competition is also very helpful in forcing this transition. When the transition takes place into matchmaking, we see that investor welfare actually increase due to regulation. Now, the key result is robust if we introduce multi-bank competition. Again, we are using US corporate bond market as our laboratory, as sort of a poster boy of what's happening. But this similar logic, we believe, would apply more broadly into many asset classes are still going through this transition into electronic trading and a more efficient form of intermediation. Just like we're doing more Zoom meetings, right? This is not as the same as in-person meeting, but hey, it is more efficient. Thank you.
Okay, so we'll go to the open Q&A to the raise hand. In the meantime, there are a few questions also in the Q&A that have been submitted, and two of them relate to the part that you just discussed about robustness checks. So I'll read those and I'll allow the rest of the question submitters to raise their hands and ask you in person. But so Lian was actually wondering about the multiple banks and multiple non-banks, and the one point that I'm not sure you addressed about his question was he was thinking about how to connect the model better to reality to measure the size of bank and non-bank dealer sectors. And then before you answer that, there is also a question from Michael Goldstein, which asks, why are you focusing on the taste for banks, and why is it not that banks have different relationships with different clients so that different searches reach different clients?
Yeah, so thank you for these questions. Let me maybe let me answer Michael's question first, which is We just need a form of differentiation. I think it's perfectly fine if banks have relationships with different clients, so that a client cannot fully choose all the banks. I think that's completely fine. In some of the search models, people indeed model differentiation this way. Again, I don't think the result really relies on this particular modeling device of taste. Back to Lian's question, we have multiple banks and one non-bank, right, in the extension. I guess in reality, yes, we got a multiple non-banks. The question here is, what do we have to differentiate these non-banks? In the model, the non-banks have only one thing to do, which is to provide liquidity on their balance sheet, right? That's the sort of market making activity. And if we believe also that there's a unique number, right, which is the cost of capital for that kind of activity, then all these non-banks could compete intensely. So I don't think the result would change as much if we introduce multiple non-banks. The key, I think, is about the competition between banks. I think, as Michael was saying, whenever it comes to banks, you always have a relationship, you always have the economy of scale, as a question earlier. So I think the multiple bank competition dimension seems to be kind of more salient, at least in the data, at least in the discussions by the practitioners and policymakers. I see Chao Jun has a question. Should I?
Yeah, so I was gonna unmute, but since you're addressing the Lian's questions, I don't know if he had a follow-up. So
okay, so maybe I follow up a little bit. I think it's so Haoxiang pretty much addressed my major kind of confusion. I think if you think about the competition among banks, the multiple dimensions, right? Like the number of banks, also the differentiation of products. So what I'm thinking is they can also predict so the choice variables. They can also think about this specialize the different things. They can provide a different niches. So that so somehow I feel that dimension can also be very important in determining the result. It's sort of capture the bio sigma. So that's I have a follow-up question on this. So you focus on customer or investor welfare. So what happens to the bank profits? I assume bank profits already decrease, right? So and also if you think about the total welfare, the profits of a bank plus the consumer welfare, what will happen to this total number?
Yeah, this is a good point. So this is exactly the slides I skipped. So you're right. So the bank's profit definitely goes down and the customer welfare could go up. Now, if we add it up, the question is now whether we have measured the bank's balance sheet cost accurately. In the extension, one of the extensions, we do have this alternative measure. We do have a view here. The view is that if you look at the bank's balance sheet cost of CB, this is lower than the activity-based balance sheet cost because of the deposit insurance, because of the too big to fail subsidy. Now, if you add it up, and we prefer to use the market-driven cost of balance sheet, which is CNB. Now, if we replace CB by CNB, we can see that the entire welfare also goes up as CB goes up. Now, but you're right. If we only use the subsidized CB in the model, then it's possible that the total welfare goes down. But we do not believe that's sort of the right measure, because CB itself is subsidized. So the too big to fail subsidy would somehow fold into it if we want to think about the entire welfare. And also, we do not really believe that the regulator should care about all welfare as much as about consumer welfare, because overall welfare has a component that is about the rent, right? It's hard to imagine that regulator would want to maximize the intermediary rents.
Okay, yeah. So but I think economics, we probably care about the total welfare. It's kind of very subjective. Yeah, thank you.
Cool. Yeah, I think Chao Jun's question, I kind of in the non-bank dealers constrained equilibrium, so the short answer is that yes, the non-bank dealer can also endogenously increase the spread. That was the question, but we did not really emphasize that in the talk, because in the talk, to us the most interesting case is when the banks dealers balance sheet cost is lower than the non-banks. So most of the action is really on the banks.
If I can follow up on that.
Yeah, please.
Actually, I was referring to the constraint bank equilibrium, the one, the equilibrium that you're interested in. In that equilibrium, the non-bank is kind of setting a fixed spread, which is a function of its balance sheet cost. And that is putting an upper bound on the bank spread, that the bank cannot increase its spread higher than that. So that's why he has to increase his matchmaking business, and that will increase the welfare of the customer. So I was just thinking that whether in a slightly different model, you could have the bank, even in that region, the non-bank can endogenously respond by charging a wider spread just to get higher profit. It doesn't happen in the current model, but it also doesn't happen in the multiple non-bank dealer situation because of the strong competition. But I'm just thinking, maybe in a slightly different model with more complicated competition, indirect competition, for example, between the non-dealers, whether that can happen.
Yeah, so in the current model, remember when the bank's balance sheet cost is lower than the non-banks, in the constrained bank dealer equilibrium, the bank is going to charge a spread that's equal exactly to the non-bank dealer's balance sheet cost, right? So the non-bank, in this case, Citadel doesn't do anything, right? So there's no incentive for it to move around, because that doesn't really change anything. So you're right, but if we want to generalize everything, for example, introduce multiple non-banks, multiple banks, and everybody would have different transaction cost, balance sheet cost, then that's possible. But I think the key message here is that whenever the non-banks pose a competitive threat to the bank, that is when the shifting into matchmaking become more intense. I think that message should still work, right? But just to keep the model very clean and very simple, we decided to do this kind of a bang solution.
Sure.
But that's a fair question.
Thank you.
So Josh Walner has a question. So Josh, you should be able to speak now.
That's good. Hi, Haoxiang, very nice paper. Just a quick question about a potential extension maybe for the model. In the model H, was this arrival rate of counterparties when you were doing matchmaking? And I was just wondering if you thought about endogenizing that parameter, right? So for example, it seems that if more customers are choosing market making, then there should be fewer customers that are available to serve as counterparties for customers who are choosing matchmaking, and maybe that should affect H. Thanks.
Yeah, this is a good point. It's the question is, is it reasonable to have this H be invariant, right, to the mass, to the fraction of people who are trying to search? So in the traditional search models, the intensity of median is increasing. It's basically linear. It could be generally increasing in the mass of people who are doing the search. So we started off this way, and the math was a little messier than now. So this is one of the simplifications we did, just to make the math a little cleaner. But we believe we could do it. I intended the consequence of modeling the way you described in the traditional search theory is that it is possible that the dealers would strategically create a huge mass of people or of investors who are just unmatched in order to increase the intensity, rather than increase the intensity by investing, right? So we sort of want to capture the latter effect, which is to do more kind of customer matching by investing in technology rather than artificially increase the mass, which I don't think is what the search model intend to capture. So that's why we have this simplification.
Okay, very interesting. Thank you.
Yeah, cool.
So it's noon, so the official part of the seminar is over, and I just wanted to say thank you to everybody for joining us, and I hope that you'll join us back in 2 weeks. We'll have Hans de Vries talking about priority rules, but if you have further questions for Haoxiang, please raise your hand so that we can unmute you and you can answer it in person. I see a question from Spencer Dean, but I don't know if Spencer, if you're still here, if you wanted to ask this in person.
I don't know if my microphone works, but I just sort of had an institutional question. How much does this hinge on a linear cost of funding? Or at least a locally linear cost of funding? Does it matter if the cost of funding is convex at all? Like if it's increasing, risk controls or something like that, impose particular on the banking sector as opposed to the non-bank, I would imagine.
Yeah, I would say that, I'm trying to think. I don't think that it hinges on the linear cost, right? So the cost. So basically, we are assuming that for every order that the customer that the dealer takes on the balance sheet, there's a fixed cost of CB. So essentially, that's linear because of the growth in the mass of customers who do market making. If we make it convex, I think that's gonna further encourage the bank to do matchmaking, right? As you do, if you really aggregate a huge amount of custom orders on the balance sheet, is prohibitively expensive, right? So that's a further encouragement of matchmaking. I guess by assuming a linear cost, we are kind of being conservative, right? Because we do not have that additional kick into matchmaking. But we believe our model is actually robust. If we have any form of balance sheet cost as a function of how many people use it.
All right, that's great. Thank you.
That's cool.
Mina, you can unmute yourself now, Mina Lee.
Okay, can you hear me? Hi.
Yep. Hello.
So I have just I just have some clarifying questions for the mechanism. So it kind of went a little fast for me that in the, I think what you call constrained equilibrium, as this balance sheet cost of the bank dealer goes up, matchmaking go down. And you mentioned that it is because the bank dealer is making lower profit from market making.
Okay, making goes down. Yeah.
I didn't quite understand why that should be the case. I thought the bank dealer should be just maximizing its own profit, making less profit on one side. Why should it lower the fee on the other side? Yeah.
So when I say market making goes down, I'm talking about the fraction of market making goes down, right? Because that by definition add up to 1. So it's entirely a shift of market making into matchmaking. The idea, I think the intuition is that when you are maximizing, these two activities simultaneously, as an intermediary, you better make sure that the two profits are kind of the same. And of course, if one profit goes down because of regulation, now the other profit now looks sort of too high, right? So you would rather expand the mass of customers and by lowering the fee. I mean, that's a result we can prove. So it's that's basically my intuition. You kind of keep the two activities equally profitable, right? As parameters change. So as the cost of market making goes up in the constrained region, the matchmaking fee goes down and matchmaking get expanded by a lot.
I mean, I don't see the intuition clearly, to be honest. Just but maybe I mean, right? Like, generally the case. Just because you're making less profit on one side, you should also lower the profit on the other side. And so, and like the next clarifying question is the intuition for the kind of source of increase in investor welfare. And so I think my understanding was that it's because more investors are now participating in the market because matchmaking fees are low. I understand if I if I take the premise that it lowers matchmaking fee, I think it makes sense that it would encourage parties to pay more. Is that correct? Is that the main source of investor welfare increase?
Oh yeah, this is a good question. So there are 3 types of investors, right? Those who pay the market making spread, they are just as well off as before because the market making spread is fixed, right, at the cost of non-bank's balance sheet. Now the people who were doing matching now are better off because the fee is now lower. Now there's a third region, which is the people who were not trading before. Now they get a trade because now they can afford the lower matchmaking fee. So in that sense, it's actually a Pareto improvement. It is a stronger notion of welfare because every single customer is at least as well off as before, and many actually strictly better off.
Right. So in terms of the kind of evidence for kind of which case, like a kind of which equilibrium we might be in the real world. So you used the evidence on the transaction cost, but I thought some additional evidence might be useful.
So
for example, like, is there evidence that there is increase in trading volume, there is increase in participation, especially in the matchmaking or the regulation?
Yes, so we have, well, maybe I went through this too quickly. In the data, the fraction of matchmaking has certainly gone up. So if you sort of look at the trades data, the dealers are actually using more and more agency trade. So the two trades look really close together with a similar volume. So that's matchmaking. So that fraction have gone up. That's one piece of additional evidence. Another piece of additional evidence is that the non-bank dealers now become a kind of larger share of entire market making activity. Right. So both of these pieces also support our, well, I would say, judgment that we are kind of in the right region of constrained bank deal equilibrium. So that's where the welfare would
I
go
mean, just to clarify, I think the first part of evidence that you gave was useful, but they could still suggest simply shifting from market making to matchmaking. The investors who were previously discouraged to participate now entering, right? So I was wondering whether there is kind of evidence that, like, some people are now more participating, not just shifting from market making to matchmaking.
Oh, I see what you're saying. That's, given the current data, is a little trickier. I think one would have to, the trace data, even the regulatory version, only have IDs of the dealers, but not the customers. So in order to get the customers' wider participation, one would have to look at like insurance company data, or mutual fund data, something like this.
I see.
Yeah, I haven't.
Okay, so I had so many questions. I only have one final comment, like question, like I thought like you might want to, like, I just was wondering what you thought about the people's discussion on violation of covered interest parity as a result of bank regulation. So in the forex market, people thought this increased balance sheet cost created this dislocations. So like, I know this is not what your paper is about, but do you have any remark on that?
Yeah, I thought about that a lot. I have separate work about the capital regulation about derivatives. I think that's an entirely different thing. There, you could use regulation and try to even do some numbers, right, to figure out for every, say, cross-currency swap, what is the capital, what is the balance sheet cost. We can discuss offline. So far, I mean, my general conclusion is that I'm not sure if the balance sheet cost can fully explain the size of the dislocation. But that's, I mean, it's also my understanding that, these things are moving really, moving around, it's anyway, we should discuss that later, which is a separate thing. Yeah.
Okay, thanks a lot. That's all my questions.
Cool. Thank you, Mina.
Thank you.
So I don't see any raised hands. I just have a general question. So you're assuming that like it's only banks that can do matchmaking, right? Because of the clientele. But why don't we have, like, outside of the model, but why don't we have some solutions that come up that do the matchmaking? Or is it not profitable? Like, why is it that like there's no decentralized platform that's entering, given the technology that's becoming available?
Yes, so there are, I mean, market access would be one example. In market access, I think the traditional method of liquidity provision is that the customer send a message to the dealers, right, request for quote. Now, the other side is still a dealer, I guess. Now, they start to use this open trading protocol in which the message could be sent to everyone, right? So that's kind of all to all. My understanding is that all to all is picking up and mostly used for smaller orders. So certainly there is trend that customer to customer trading without any dealer intermediation is taking place, but that's still a smaller part. So I get maybe in 5 years, right, when that part becomes big enough, right, one would need to write a model that basically says, investors could organize themselves into a more of a centralized platform and the trade among themselves. But I guess for now, at least given the data around the regulation of the bank regulation in the last crisis, that part is not a salient piece of the data. So that's why we didn't really put that in.
Thanks.
Yeah.
Okay, well, unless there are any further questions, that would conclude the seminar. So thank you again for coming. Thanks, Haoxiang. It was a great paper. If anybody has further questions for Haoxiang, you know where to find him. So thanks again.
Great. Thank you very much for having me.
See you in 2 weeks. Thanks.
See you. Bye-bye.